In this video, we're going to talk about the 5 mistakes that investors keep making when trading Tesla stock. And you're not going to want to skip this video because I guarantee you are making at least one of these mistakes. I was too. And I had to fix it, and you'll want to fix any mistakes you're making as well, because this Tesla trend, as we all know, is a once-in-a-lifetime opportunity. You don't see many stocks take off like this one. Our boy Elon Musk here can make us a lot of money. So we want to make sure we're making as much as we can. So the first mistake that investors make when they trade Tesla is investing too much into Tesla. And I know a bunch of people are already mad at me for saying this because they love going all in. But no, that is not the way to do it. And really, this leads us into one of the most important aspects of investing that no one really focuses on. Now, professionals do, and hedge fund managers do, and that's why they're so successful in the market, but most standard investors don't. And what I'm talking about here is position sizing. It is one of the key factors in actually having success in the stock market, especially over the long term. And here's the thing, how much you're investing in a particular stock is even more important than what that stock is, which I know is crazy to a lot of people because we all spend so much time trying to find something like Tesla, right? It's the dream stock. Doing all this research, always just focusing on the stock pick. But guess what? The truth is that that's only 10% of the process. Stock picks aren't as important, I'm sorry. The other 90%, the truly important part, that's the trade management, which includes position sizing. Now, let me tell you another truth about professionals in the market. They actually lose a lot. There are legendary hedge fund managers, guys like George Soros or Stanley Druckenmiller, and their actual win percentage on their trades or the investments that they're making is only around 30-35%. So how can they be making billions of dollars if their hit rate is so low, if they're getting so many things wrong? Well, the reason why is because of their position sizing. So if you're sizing your positions right, you're allowed to be wrong because you don't lose that much when you're wrong. And the goal, obviously, in the market is to lose just a little bit when you're wrong and then make a lot when you're right. So now with Tesla, we have a problem where most people are going in way too big, putting it all in, taking a second mortgage on their house and putting it into Tesla. The mentality is hey, Tesla has done so well so far, let's put more in. Let's pile in as much as possible. And we see the stories of people making a lot of money doing this. And yeah, it does seem awesome on the upside, but what happens when it turns around? Are you going to be able to stomach that huge drop in the stock? Even if you believe in the long-term future of Tesla, there are going to be big drops in between now and then. I mean, look what happened in March of 2020. That was over a 60% drop in just a few weeks. And that's what happens with these high flyers. And when that happens, ask yourself, are you going to be able to sleep at night? Are you going to be able to follow the strategy that you have in place when your position size is huge, when you have everything in Tesla, your whole life savings is riding on it? No, you're not. Here's a general rule of thumb. If it keeps you up at night, your position size is way too big. And swings like that, especially on large amounts of money, I mean, that's difficult for anyone to handle. So when you start feeling your emotions taking over when you're trying to invest, you know you have way too much money invested. And that brings us to mistake number 2 investors make with Tesla, and that is not taking profits. Again, the mentality of putting it all into Tesla and holding, that is not the way to go. Yes, your profits do get bigger when the stock is rising, but in reality, it's all paper profits. You don't actually have those profits until you sell the stock and take that money off the table. Now, this is an obvious concept, but it's something that's very easy to forget, and a lot of us do, which is why this is mistake number 2. And like we just said, big drops happen in stocks like this all the time. And when it happens, those paper profits disappear pretty quick. So the trick then to avoid that happening is to lock in those profits on the way up. So how exactly do you do that? How do you take profits? Because obviously you don't want to sell everything, right? Because a trend like Tesla, if it's super hot and it keeps going, there's just more and more money to be made. That is true. So you want to benefit from that, but at the same time, you want to be managing your downside in case it does turn around. So the best way to do that is to take partial profits. And a good way to go about that is by setting price targets. So we can see an example right here. Say we invested in Tesla at the perfect time, the bottom of March. Well, what we could have done is set price targets on the way up. And this is actually what we do in our Fallible strategy. So for example, you could say that, okay, if I got into Tesla on March 18th right here, once it moves up 20%, I'm going to take some profits. So you can see it moved 20% pretty quickly. And at that point, you could sell a few shares, lock in those profits. But okay, you're probably thinking, no, Tesla is a monster. I'm not going to sell after a 20% gain. Fine, make it whatever percentage you want. Say after 100% gain. So once again, it hit that 100% gain pretty fast if you invested at the bottom of March. And again, that would have been a perfect investment. So not exactly easy to do. Whatever target you want to set it and then take some profits. And how much you want to take, that's up to you too. If you only want to sell 10% of your position, so be it. You want to sell 20, 30, go for it. So some people like to set these targets all the way up, which is an effective strategy. Others like to sell enough that they lock in their initial investment. So even if the stock went to zero, they sold enough to break even. So it's really up to you and what you feel comfortable with, but the important thing is that you are taking them. And when the stock collapses, you can add more to your position. So really your position sizing and how much you have invested changes with the market. And that's what the whole concept of trading around a position is. It's very profitable and it's way more safe for your money too. Because one thing that people always forget is the downside. You always got to think about that when you're in the market. But all of this only works if you avoid mistake number 3. And that is being too emotionally attached to Tesla. So many people are just ride or die for Tesla stock, which is so stupid. Not because Tesla is stupid or something. I'm a huge Tesla and Elon fan. One of the biggest. But I keep that opinion and my feelings about it away from my investing because you should not be attached to any stock, not just Tesla, no matter how great it is. As the saying goes, trade them, don't date them. The problem is, as soon as you lock yourself emotionally into a trade, you'll start making bad decisions. You'll make mistakes like number 1 and 2, investing too much and not taking profits. All because you're such a die-hard believer of this company. But guess what? The market doesn't care about your beliefs. It can and will absolutely crush great companies. And if you're emotionally attached, then you're not going to sell when you need to. And the problem is that these companies can stay down for a long, long time. It really depends on the market environment. Anybody remember Tesla between 2014 and 2017? Still a fantastic company in my opinion. But look, it just traded sideways for 3 years. Then after its initial pop in 2017, what happened? Traded sideways again. In fact, it even collapsed. Look at that, 53% down. That is many, many years of a stock going sideways, even though the company was fantastic. Elon was fantastic. If you're attached and you're just letting your money sit there, what's the point? Who is that benefiting? It's dead money. It doesn't make any sense. And selling Tesla stock doesn't mean you're against Elon. They're completely separate. Don't worry. This is why you don't want to get your emotions mixed with the stock market. It's dangerous. And that brings us to mistake number 4, which is kind of like the opposite of the rest. It's investing too little into Tesla. See, the position sizing that we've been talking about is kind of like a Goldilocks problem. You don't want too much, but you don't want too little either. You just got to make it just right. And then you got to run away from the bears. I don't know who drew this. It looks terrible. But great detail with, what is that, a little mosquito bite? Kind of strange. And this baby bear with a jacked up foot. But anyway, what I was saying is that if you invest too little into Tesla, then you're not going to benefit off of one of the greatest runs of all time. It's the idea of diversification. And that's a concept where you have too many stocks and you're too diversified, so you never actually get the gains of the few winners. So you can't do better than the market because you're basically the market itself. Like the S&P 500 is what, 500 stocks if you invest in that index. So in our Fallible portfolio, we only hold 5 stocks, and they're the 5 best stocks in terms of momentum. And that way, if anyone shoots up, we're going to get the proper gains from it in our portfolio. If we were holding 50 stocks, then what's going to happen? Each position size is so small, you can't really benefit from it. And it's a pain managing 50 stocks too. I see a lot of investors with smaller amounts of money managing like 20 stocks. Why? Just buy an index ETF at that point. It's like what Warren Buffett said, diversification is protection against ignorance. It makes little sense if you know what you are doing. Now again, I personally don't invest as heavy into something as Buffett does as a value investor. So that's why I say it goes back to Goldilocks, getting it just right. Not too big, but not too small. And an even worse mistake to make than investing too small is to not invest at all. And there are a lot of people that refuse to invest in Tesla because they just hate the company so much they think it's a Ponzi scheme or something like that. I don't know. The Tesla Q crowd, have you ever run into them on Twitter? Oh my God. It's horrible, and they let their nonstop bearish perspective blind them. And because of it, they are sitting out on a huge, huge moneymaker. And these guys are the opposite of the true believers. Instead of getting too attached to the stock, they're attached to the idea of hating the stock. It's very stupid, and I don't know what it is. Are they trying to prove something? Do they want to say in the end, oh, we told you so, Tesla was a fraud? But here's the thing, even if Tesla is a fraud, which again, I don't think it is, I'm a big fan, but even if it is a fraud, look at this run. It is just insane. Can you imagine missing out on all of this just because of your bias against Elon and Tesla? It is so stupid, but it's also so true that people enter the stock market for various reasons. A lot of times trying to prove things to other people. And it's weird, right? Because you think, why are you in the stock market other than to make money? But subconsciously, people are doing crazy stuff. So you got to remind yourself, hey, I'm only here for one reason, to make those profits, not trying to get emotional with it. The stock market does one thing and it makes me money. And at the end of the day, your opinion doesn't actually matter. The only thing that matters is what the stock price is doing. And of course, how you manage your investment in that stock. And this brings us to mistake number 5, which is the absolute worst mistake you can make. And this, I would say, is the most important point of this whole video. And really, it's the key to investing in general. If you're investing in the stock market at all, especially in a stock like Tesla, then you need to know this. It's so important that I actually made a separate video about it, which I will put right here. You can watch that video by clicking right here. And again, it's super, super key. A mistake you definitely do not want to make. And it's going to help you out so much in the market once you realize what I'm talking about. So click this video right here and I will see you there.